The Federal Reserve just made its decision for April 2026. Rates held again. But if you think that's the whole story, you missed what actually happened today, because this wasn't a normal Fed meeting. There was a dramatic split vote, a historic leadership change, and a signal about inflation that markets did not like. Here's everything that happened and what it means for your money going forward. Before we go further, nothing in this video is financial advice. Signal Markets is an educational channel. We analyze publicly available data to help you understand markets. Always do your own research and speak to a qualified advisor before making any investment decisions. Let's start with what was decided. The Federal Open Market Committee voted to hold the federal funds rate at 3.5 to 3.75%. That's the third consecutive hold, January, March, and now April. No surprise there. But here's what was surprising. The vote was 8-4. Visual, vote split graphic, 8 versus 4. 4 members of the FOMC dissented. That means 4 of the 12 voting members wanted something different, likely a rate cut given the economic uncertainty created by the Middle East conflict. An 8-4 split is highly unusual. Most Fed decisions are unanimous or near unanimous. A split this wide signals genuine disagreement inside the Fed about which direction the economy is heading, and that uncertainty matters for markets. The official statement kept language largely unchanged from March. Economic activity expanding at a solid pace. Inflation remains somewhat elevated, and crucially, the implications of developments in the Middle East for the U.S. economy are uncertain. That last line is doing a lot of work. It's the Fed's way of saying, we don't know how bad this gets. Now to the bigger story. Today was almost certainly Jerome Powell's last press conference as Federal Reserve Chair. His term ends on May 15th, just over 2 weeks from now. After more than 8 years leading the most powerful central bank on earth, Powell is stepping aside. Visual, timeline graphic, Powell tenure 2018 to May 2026. In today's press conference, Powell confirmed he will remain on the Fed's Board of Governors after his chairmanship ends. His governor term runs until 2028, so he won't disappear entirely. But his role as the decision-maker, the face of monetary policy, the voice that moves markets, that ends on May 15th. Powell also congratulated Kevin Warsh on his path to confirmation. The Senate Banking Committee advanced Warsh's nomination today, the same day as the Fed meeting. The full Senate vote is expected the week of May 11th, just before Powell's term expires. Visual Kevin Warsh photo Senate confirmation graphic. Who is Kevin Warsh? He served on the Federal Reserve Board from 2006 to 2011. He was Ben Bernanke's right-hand man during the 2008 financial crisis. Markets generally view him as credible and stable. But there is one concern. Only 50% of respondents in the latest CNBC Fed survey believe Warsh will conduct monetary policy independently of political pressure. That's a significant worry. Fed independence is the foundation of market confidence in the dollar and in U.S. financial stability. Watch this closely over the coming months. Back to the economics, because Powell's tone on inflation was the hawkish signal markets were watching for. Inflation remains elevated. That was the clear message. And the primary driver is energy prices. Oil has been trading near $96 per barrel due to the ongoing conflict in the Middle East and the blockade of the Strait of Hormuz. Petrol prices in the U.S. have hit $4.23 per gallon as of today. Powell emphasized that the situation in the Middle East is contributing to a high level of uncertainty about the economic outlook, and that the committee will assess rates meeting by meeting. No forward guidance, no promises, no hints about when cuts might come. That phrase, meeting by meeting, yours is the Fed's way of saying, we have no idea what happens next, and we're not going to pretend we do. Markets did not like what they heard. The Dow Jones fell 300 points. The S&P 500 and NASDAQ each dropped. The 10-year Treasury yield hit 4.41%, near its session high, as investors priced in the reality that rate cuts are not coming soon. The signal is clear. As long as oil stays elevated and the Middle East conflict continues, inflation stays sticky and the Fed stays on hold. So what does all of this mean for your investments? For stocks, the market reaction today tells you what investors think. Slightly negative. Higher for longer rates mean more pressure on corporate borrowing costs and valuations. The Dow down 300 points is not a crash, but it's a signal that the easy money environment is not coming back yet. For crypto, Bitcoin remains highly correlated with the S&P 500. When stocks fall on hawkish Fed signals, crypto follows. Watch whether Bitcoin holds support around the $78,000 level in the coming days. If it breaks below that, macro pressure is winning. For gold, this environment is gold's best friend. Elevated inflation, Middle East uncertainty, a Fed that can't cut, all three are bullish for gold. If you're watching one asset class that benefits from today's decision, it's gold and commodities broadly. For savers, good news. Rates staying at 3.5 to 3.75% means high-yield savings accounts and money market funds continue paying 3 to 4%. That's real return above inflation for cash holders, something that hasn't existed for most of the past decade. The key date to watch now, May 15th, when Kevin Warsh takes over. His first press conference as Fed chair will be the most watched in years. Here's the bigger picture from today. The Fed is navigating three simultaneous problems at once, something they almost never face together. Problem 1, inflation above target driven by an external shock, oil prices from the Middle East conflict that monetary policy cannot fix. You cannot cut rates to bring oil prices down. Problem 2, slowing economic growth. Q4 2025 GDP was revised down to just 0.5%. That's dangerously close to contraction territory. Problem 3, a leadership transition at the worst possible moment. The most uncertain macro environment in years, and the Fed is changing its captain. This combination, sticky inflation, slowing growth, and leadership uncertainty, is what keeps the Fed on hold, and it's what keeps markets nervous. The one wild card that changes everything. A de-escalation in the Middle East. If oil prices fall, inflation drops quickly. The new Fed chair has room to cut, and risk assets rally hard. That's the scenario bulls are waiting for. Watch oil prices and Middle East developments as closely as you watch the Fed. Right now, they're the same story. That's your complete picture of today's Fed decision, the third consecutive hold, an 8-4 split vote. Jerome Powell's final press conference, and what it all means for stocks, crypto, gold, and savings. To summarize the key signals, rates hold at 3.5 to 3.75%. Third consecutive hold, but a dramatic 8-4 split. Inflation remains elevated. Oil and the Middle East are the primary drivers. Powell's era ends May 15th. Kevin Warsh takes over with markets watching his independence closely. Meeting by meeting, no forward guidance, maximum uncertainty. Watch oil prices. They are driving this entire macro story. If this kind of analysis is useful, connecting the Fed, inflation, energy prices, and what it means for your portfolio, subscribe to Signal Markets. New video every week. No noise, just the signal. Link to our platform of choice is in the description below. As always, do your own research, and nothing in this video is financial advice. This is Signal Markets. Find the signal. Ignore the noise. See you next week.